In the heart of Houston, Texas, a corporate titan was born in 1985, Enron. This behemoth began its journey as a modest enterprise, a union of two companies, Houston Natural Gas and Internorth. The man steering this nascent venture was none other than Kenneth Lay. A PhD in economics, Lay was a visionary, a charismatic leader who seemed to hold the keys to a prosperous future. He was the architect of the merger, and under his guidance, Enron was set to soar. In its early years, Enron was a beacon of promise. It was not just another energy company, it was a pioneer, making strides in the largely uncharted territory of energy trading. With Lay at the helm, Enron ventured into the nascent market of natural gas futures. This bold move was not without risk, but it paid off handsomely. The market boomed, and Enron, being one of the first entrants, reaped substantial benefits. This was just the beginning. The company's growth was nothing short of meteoric. From its humble origins, Enron expanded its footprint in the energy sector, diversifying into electricity, coal, and even steel. It was a golden age, a time of rapid expansion and seemingly limitless potential. The company's success was not just reflected in its growing portfolio. Its stock price soared, and it quickly became a darling of Wall Street. Investors were captivated by Enron's bold vision and its impressive financial performance. But beneath this dazzling veneer, there were rumblings of trouble. As Enron grew, so did its appetite for risk. The company ventured into increasingly complex transactions, pushing the boundaries of what was legal and ethical. As the new millennium dawned, Enron seemed unstoppable. But for those who looked closely, there were signs of cracks in the facade. The company's aggressive risk-taking and opaque financial dealings were a ticking time bomb, ready to explode. Enron, under the helm of Kenneth Lay, was ready to conquer the energy market and more. But as we'll see, this corporate colossus was standing on shaky ground, and its spectacular rise was about to be matched by an equally dramatic fall. Enron was on a meteoric rise, quickly becoming a darling of Wall Street. It was an era marked by innovation and big dreams. Enron was right there in the thick of it, leading the charge with a business model that was as groundbreaking as it was audacious. At the heart of this revolution was energy trading. Enron was the pioneer, the trailblazer that dared to see the potential in what was then an unexplored market. The company didn't just dip its toes in the water, it dove headfirst, betting big on the future of energy. And what a bet it was. Enron's aggressive expansion into energy trading paid off in ways that few could have predicted. The company was not only creating a new market, it was dominating it. But energy trading was just the beginning. With the success of its pioneering model, Enron began to cast its eyes on new industries. Broadband, water, steel, you name it. If there was a market to be disrupted, Enron wanted in. And Wall Street loved it. Investors couldn't get enough of this brash, bold company that seemed to have a Midas touch. The stock prices reflected this adoration, skyrocketing to dizzying heights that were unheard of for a company in its industry. The financial world, too, showered Enron with admiration. The company was lauded for its innovation, its daring, its seemingly unstoppable growth. It was held up as a shining example of what a company could achieve when it dared to think outside the box. The turn of the new millennium saw Enron at its peak. The company was riding high on a wave of success and adulation. It was making big moves, shaking up industries, and raking in profits. By the end of the 1990s, Enron seemed unstoppable. But as we would soon discover, all that glitters is not gold. Sometimes it's just a mirage, a beautiful illusion that hides a much darker reality. But beneath the glittering facade, the foundations of Enron were rotting. This was a company that had built an empire on the illusion of success, masterfully weaving a complex web of financial engineering that would ultimately lead to its downfall. At the heart of this deception were key figures like Jeffrey Skilling, Enron's CEO, and Andrew Fastow, the company's chief financial officer. These were the puppet masters, pulling the strings behind the scenes, manipulating the numbers to paint a picture of prosperity and growth. Skilling, the visionary, was the architect of Enron's aggressive investment strategy. He was the one who pushed for the adoption of mark-to-market accounting, a method that allowed Enron to record potential future profits on the day a deal was signed. This was a game changer, but it also opened the door to immense manipulation. Fasto, on the other hand, was the engineer, the mastermind behind the creation of countless off-the-books entities. These were shadowy, complex structures designed to hide Enron's growing debt and inflate its profits. They were named after Star Wars characters, a bit of dark humor that underscored their purpose to cloak Enron's true financial state in a galaxy far, far away. But, like any house of cards, the more layers you add, the more unstable it becomes. As the company continued to pile on debt and hide its losses, the structure began to wobble. The inflated profits couldn't mask the reality forever. The off-the-books entities, once the saviors of Enron's balance sheet, became ticking time bombs. By the late 90s, whispers of Enron's dubious accounting practices started to circulate. Skeptics began to question the legitimacy of Enron's profits, the opacity of its financial statements, the true nature of its partnerships. The financial world started to look a little closer, to probe a little deeper. As the new millennium dawned, the cracks in Enron's armor started to show. The illusion of success was beginning to shatter, revealing the rot at the core of Enron's empire. And once those cracks started to appear, it was only a matter of time before the whole structure came tumbling down. In 2001, the illusion shattered. Enron's house of cards came crashing down. The year was marked by a series of revelations that shook the foundations of the corporate world. The once mighty titan that was Enron was revealed to be nothing more than a mirage, a grandiose spectacle of smoke and mirrors. The shocking revelation began with the unraveling of Enron's massive accounting fraud, a complex web of deceit and manipulation that had inflated the company's profits and hidden its debts. The intricate schemes that had been used to fool investors and regulators were laid bare, exposing the ugly truth behind the company's spectacular success. As the news of the fraud spread, Enron's stock prices began to plummet. The once towering giant, whose shares had once been the darling of Wall Street, was now a pariah. Investors scrambled to sell their shares, leading to a rapid and devastating fall in the company's value. In a desperate attempt to salvage what was left, Enron filed for bankruptcy in December of that year. The bankruptcy filing was the largest in US history at the time, a grim testament to the magnitude of Enron's fall. The shockwaves of Enron's collapse reverberated throughout the financial world. The disbelief was palpable. How could a company that seemed so successful, so invincible, fall so spectacularly? The scandal shattered the illusion of invincibility that had once surrounded the corporate world, exposing the vulnerability of even the mightiest of giants. But the impact of Enron's fall was not limited to the financial world. The company's employees, many of whom had invested their life savings in Enron stock, were left with nothing. The devastation was immense, a stark reminder of the human cost of corporate greed and deceit. Enron's fall was swift and brutal, leaving a trail of destruction in its wake. The scandal serves as a stark warning, a reminder of the dangers of blind trust and the importance of due diligence. It is a lesson that investors should never forget. Enron's collapse left an indelible mark on corporate America. In the wake of the scandal, the repercussions were swift and far-reaching. Key figures who once stood at the pinnacle of success found themselves in the crosshairs of justice. The once mighty auditor, Arthur Andersen, was also swept up in the storm, dissolving under the weight of its own complicity. The Enron debacle was a wake-up call, leading to a seismic shift in the corporate landscape. It brought to light the dire need for stricter regulations, and as a result, the Sarbanes-Oxley Act was born. This legislation revolutionized corporate governance, mandating greater transparency and accountability to prevent such fraudulent schemes from happening again. But the aftermath of Enron goes beyond the boardrooms and courtrooms. It seeped into the psyche of every investor, changing the way they viewed and approached the market. The scandal underscored the importance of due diligence, of not just taking a company's word at face value, but digging deeper, questioning, and analyzing. The tale of Enron is a stark reminder that not all that glitters is gold. It's a lesson in the dangers of blind trust, of the perils of putting too much faith in charismatic leaders and glossy profit statements. It's a lesson in the importance of diversification, of not putting all your eggs in one basket, no matter how promising the returns may seem. It's a lesson in the importance of understanding your investments, of not diving into murky waters without having a clear picture of what lies beneath. Above all, it's a lesson in skepticism. It's a lesson that when something seems too good to be true, it probably is. This is a lesson that Enron taught us in the most brutal way possible, and one that we would do well to remember. Enron's story serves as a stark reminder. When it comes to investing, if something seems too good to be true, it probably is.